Good morning, everyone, and thank you for attending today's webinar. My name is Chirag Shahabi Azad, Director of Research at the Global Risk Institute, and we are delighted that you have taken the time to join us today for the third event in our macroeconomic policy webinar series, the 2026 Housing Market Outlook, Finding Equilibrium in a Cooling Economy. After our previous two events that focused on fiscal policy and the state of the Canadian economy, today we turn our attention to the Canadian housing market. Housing remains a major area of concern for policymakers, financial institutions and lenders, and of course the Canadian consumer that has seen a steady rise in the share of disposable income going towards housing expenditures. Before we get started, a reminder that this webinar is being recorded and the video will be posted to the GRI website in a few days. Your microphones are muted to avoid background noise. And if you have a question for our presenter, please submit it through Slido or in the WebEx chat. And finally, near the end of the webinar, you'll be asked to fill out our event survey. It is very short, and we hope that you will take the time to complete it. Okay, so let's get right into it. With interest rates about as low as they're likely to go and home prices still well below their 2022 peak, real estate investors, buyers who have been waiting on the sidelines for the right opportunity to enter the market, and policymakers are all looking for market direction or the proverbial market bottom. Given current economic conditions and the overall volatility, it is too early to definitively say that we have found direction in the housing market, though things are beginning to stabilize to some extent. Sales still remain weak in what is being referred to as the longest winter in Canadian real estate market activity, especially in the GTA, where activity hit a 25-year low. To make sense of all of this, today we're very fortunate to have Robert Kapsik with us for his fourth annual Canadian Housing Outlook. Rob is Director and Senior Economist with BMO Capital Markets and a leading expert on Canadian housing markets. Since joining BMO in 2006, Rob has played a key role in analyzing Canadian economic, fiscal, and real estate trends, contributing to several BMO publications, advising policymakers, and commenting frequently on economic and financial trends in the media. A lot has changed since Rob's talk from last year. While our economy has proven to be resilient, tariffs and the overall uncertain economic environment have taken a toll. Rob, we're eager to hear from you and if your assessment of the housing market has changed since last year. Over to you.
Great. Thank you very much for the intro, and again, appreciate the invite to speak to the group again. So you're right. I mean, it's funny. A lot has changed in the macro economy in that context over the last year. A lot, like significant amount of change. Interestingly enough, the housing market story really hasn't changed all that much in the sense that is still kind of evolving the way we've expected it was going to evolve, and that is we're in a multi-year correction. That's just an adjustment from the froth and the excess that built up through the height of the pandemic boom. So what I'll do is spend a little time here, give you some of the context that we're working in from a macroeconomic perspective, so we can look at the growth outlook as it stands right now, what we see with respect to things like fiscal policy, immigration, inflation, and the outlook for interest rates, and that kind of sets the backdrop for the housing market. And to your point, this is an ongoing process of cleaning out the froth that built up in the market, and we're not quite there yet. We've made progress, but we're still not quite there yet. Okay, so from an economic perspective, the landscape is obviously being impacted by a number of factors, not the least of which is the trade war. So when we look at the backdrop in the U.S., first of all, it's a very, very solid economic backdrop. It's probably seeing growth run at roughly 3% right now. Big AI boom, big increase in productivity growth there. So as much as we maybe don't like to admit it, the reality is that the U.S. economy is a significant driver of what we see with growth trends in Canada. So I would read that as a positive right now, just all other things equal. Of course, all else is not equal, and one of those big factors is that, well, yes, you have a strong U.S. economy and our biggest trading partner, but our biggest trading partner is kind of standing up and saying, we don't want to do business with you anymore. That's not a great backdrop to be in. So the biggest issue that we kind of hear out there is that the actual level of tariffs, and we don't need to go into all the gory details of this, but the actual level of tariffs on the Canadian economy are manageable. The biggest issue is that firms have a lot of uncertainty right now, and it's hard for a firm to go out there and make a big hiring decision or a big capital investment decision when they don't know what the rules of the game are going to be 3 months from now, 6 months from now, 2 years from now, right? So that's that's applying a bit of a headwind. And all the while, you do have fiscal stimulus coming down the pipeline. You have interest rates which are back down towards uh, at least neutral territory, if not slightly stimulative. So that kind of leaves us with um, you know growth running at about 1.5% or slightly below in 2026, probably firming up a little bit through the back half of the year. And again, the way you kind of always characterize this, it's like driving down the highway at 75 kilometers an hour, right? We're not in recession, we're not going backwards, but we're going below the speed limit. And if the speed limit for Canadian economic growth is closer to 2%, we're just kind of held at this slightly below potential rate until some of these headwinds clear up. And hopefully that is through the second half of 2026 if we get some more clarity on the trade front. Um, so that's a big source of uncertainty. What is pretty certain right now is that there's a pretty significant wave of fiscal stimulus coming down the pipeline, not only in the US, but on the Canadian side as well. So we all saw the federal budget a few months ago with a $78 billion deficit this fiscal year, probably adding about half a percentage point to economic growth through 2026. And I would say the bigger takeaway for the economy and for markets overall is that yes, it's another liberal government, but it's a very different looking liberal government from a policy perspective. I remember what happened during the election campaign, right? The liberal government basically took the conservative platform and put their own big red sticker on it and effectively adopted a lot of the more conservative, more pro-growth policy. So if we look at things like personal income tax cuts, accelerated CCA, even some of the stimulus through the GST credit that was rolled out a couple weeks ago, topping that number up as well. And then just a bigger push even into areas like private sector investment, more positive tone on things like the resource sector and the pipeline build out, pretty significant wave of infrastructure spending, and even scaling back to help fund that, scaling back some of the employment and spending in the public sector itself. So big takeaway here, again, without getting into all the gory details, is that we would probably read this as a favorable pro-growth policy shift in Canada. And so if we can clear up some of the trade headwinds later this year into 2027 and beyond, we're left with an environment where policymakers are actually putting down a pretty favorable floor for the economy to then kind of bounce back and grow off of. So we'll see how some of this gets executed. Obviously, things like major project build out and stuff like that is going to depend a lot on the execution, not only at the government level, but in the private sector as well. But again, big takeaway here is that the groundwork is being set for much more favorable pro-growth policy from a fiscal perspective in Canada. So that is helpful. On the employment front, so very quickly on the employment front, we are looking at a job market that it's not strong by any means, but it's certainly not breaking down as you would typically see in a recession. So from a real estate perspective, I mean, yes, a lot of the tailwinds that we saw through the earlier stages of the cycle when employment was really accelerating and wage growth was ramping up, that has cooled off quite a bit, right? So job growth has really moderated, wage growth has leveled off. The unemployment rate has probably peaked, and the unemployment dynamic is a little bit different this cycle because it's not necessarily been driven by job loss, it's been driven by labor supply growth. And what we're actually seeing now, and we'll get into the population story in a minute, is that population caps that have been put in place have put a pretty hard cap on labor force growth. So we actually do see the job market stabilizing and holding relatively firm through 2026. And in a backdrop of much slower supply growth, we actually do see that unemployment rate having peaked and drifting lower through 26, 2027. So we think about things like, delinquencies and forced selling out there in the real estate market. In this environment, that still kind of remains relatively limited. Where there's maybe one thing to mention here is that we are starting to see more of a regional fracturing in economic performance. So if you think of where the trade war is hitting hardest, areas like southwestern Ontario with the auto sector, rural Quebec with steel and aluminum, you're starting to see signs now that pockets of the economy there are starting to struggle a little bit more. And you see that in the job market numbers as well. And there are pockets of the economy like Alberta and the prairies and parts of Atlantic Canada where frankly, tariffs, especially in oil producing province, aren't really that big of a deal. And the economy and the job market in those regions are really kind of blowing this off and going on and continuing to do their own thing. So I think the other takeaway here is in the aggregate, yes, a pretty stable job market, but below the surface, we are starting to see some more regional variation again. And that's coming off a period where regional variation in job market conditions in Canada has been exceptionally low. So that'll be one area to watch. From an immigration perspective, so this is really, when we start talking about the nuts and bolts of the housing market, this is really one thing we have to keep in mind as a major driver in the background. And this is probably something we talked about a year ago as well, because immigration changes really started in the fall of 2024. And so that's just a picture of Canadian population growth going back over the last decade. Couple quick takeaways here. Number one is that historically, about 500,000 people per year was the run rate, 400,000 to 500,000 people per year. It was about 1% population growth. It was a number that was enough to fill the labor force pipeline with new immigrants, which of course Canada does need going forward. But it wasn't so much as to actually stress demand conditions, supply and demand conditions in the housing market. Of course, then 22, 23, 24, we saw population growth accelerate to, at 1.3 million people per year, almost 3.5% population growth. And there was a big debate out there, of course, about, more housing supply. We have a supply shortage issue. Look, the reality is, and this has been our view all along, is that when you go from steady state 1% population growth to 3.5% overnight, that's a massive demand shock. The supply side of the market is never going to be able to respond fast enough to that, and that's exactly what we saw. Rents and home prices just getting stressed higher, and it's spread across broader infrastructure in the Canadian economy as well, services, inflation, things like that. So long story short, policymakers saw that, realized, well, this has become a problem, so we're going to turn around and put some pretty hard caps in. The bars on this chart, of course, break down the components of population growth. So those green bars is permanent immigration, as we've kind of always known and thought about it. Those targets are largely unchanged, around 380,000 people per year. The orange bars are births. Canada does not have a lot of babies. It is what it is. I always say, don't look at me. I have 3 of them, so I'm mathematically doing my part, but it's a developed world problem. We just don't have a lot of babies, right? So it actually reinforces the need for that permanent immigration flow. The big swing factor, of course, and this was a story that was not really well known, but it's very well known now, is that those blue bars are non-permanent residents. And those are international students, temporary foreign workers, and that's where the caps are hitting hardest. So with Ottawa targeting a 5% non-permanent resident share from almost 7.5% as of a couple quarters ago, that implies a pretty significant drain out of non-permanent residents. And on net, adding everything up, it implies basically no population growth for 26, 27 through part of 2028. And then we settle back into something around, let's call it, it's about 0.8%, but let's call it just under 1% population growth over the medium term. So getting us back to that steady state. So in the interim, though, there's a really significant adjustment, and it's probably one of the biggest economic factors out there in Canada from a macro and a real estate perspective before the trade war actually started to suck up all of the airtime. So that's context we need to keep in mind as we get into the housing outlook. And case in point here is the rental market was extremely tight. Rents were rising at double digits. Policymakers were trying to push supply. With the stroke of a pen, the minute these population caps came in place, almost overnight, rents peaked and started to fall across most major cities in Canada. So by normalizing the demand curve, we've almost overnight taken a lot of stress out of the housing market. A couple other things here on the inflation front. So it's pretty stable at around 2.5% in Canada on inflation. And of course, the Bank of Canada publishes like 4 or 5 different measures of inflation to confuse investors and to confuse everybody. But when you look at the various measures, strip out some of the issues like tax changes at the federal level. If you look over the last 1 month, the last 3 months, 6 or 12 months, we seem to be settling into around 2.5% for core inflation in Canada. That's what the numbers show. That's, not coincidentally what the Bank of Canada is communicating to the market too, that's about where they see underlying inflation right now. And so the takeaway here is that a lot of the, post-pandemic issues that were driving above target inflation have more or less normalized. So the good side of the economy is normalized. Oil and ag prices have leveled out. There's a bit of upside pressure right now, obviously, as we speak, but for the most part, they've leveled out. And then on the real, probably the biggest source of disinflation right now would be on the housing side, with prices down and rents starting to fall, mortgage interest costs as well coming down. So all that to say, from a Bank of Canada perspective, it's a pretty comfortable spot for them. Where we're a little bit stuck, and maybe the reason why the Bank of Canada is hesitant to cut rates further, is that wages are growing about 3%, which isn't a bad thing, especially when we're looking for real disposable income growth to help offset some of the economic shock. That's not a bad thing, but it is technically inflationary, and the bank's aware of that. And then there's a psychology out there in the economy too that's still on the inflationary side. So when we're looking at things like the Business Outlook survey or consumer surveys, the reality is you come off a period where you have 6, 7, 8% inflation, and those expectations remain a little bit embedded. And that's something the Bank of Canada doesn't want to mess around with too much. And a good way to look at this is if you look at just the level of prices over time in the Canadian economy, yes, inflation is back to, let's say, 2.5%. But the problem is, when you walk out of the grocery store, your grocery bag isn't getting any cheaper. In fact, it's still probably about, based on CPI numbers, it's still probably about 30 or 40% more expensive than it would have been 10 years ago. Good chunk more expensive than it would have been even, 3 or 4 years ago. So you look at like some sides of the inflation equation, like clothing, recreation. Yeah, great, you can go out and buy a spin bike for less, or childcare costs are down because of government subsidies, and cell phone and internet prices are technically down. But the reality is, like, the basket of goods that really reinforces inflation expectations is still pretty elevated. And so you look at this backdrop, and one way to think about it is inflation's fine unless you have to live somewhere, eat, and get yourself to work. And in that case, well, it's not fine because we've seen such a significant shock. So the point here is that this is still kind of rooted in inflation expectations, and the Bank of Canada, considering that, has this kind of trade-off to make. And the trade-off is that, on the one hand, you have growth running below potential. The other hand is you have inflation that's still probably 0.5 percentage point above the target, with expectations at the consumer level still a little bit stuck. So what does the central bank do? Well, central bank has cut rates down to right about where it believes neutral is for overnight policy rates, technically at the very low end of that, and kind of erring on the side of a little bit of stimulus, just given what's happening with the trade war. But probably not doing a whole lot more than that at this stage, just given the balance that they're trying to strike here. So our outlook for the Bank of Canada, we can be really quick on this, is we just don't see them doing anything through 2026. As we get into the end of the year, into 2027, depending on what happens, especially with the US economy and with the trade backdrop, it's really possible that the next move for policy is actually a tick higher, and not further to the downside. So that's the big takeaway. And look, like, the Bank of Canada is telling the market as clearly as they ever tell the market right now that they're very happy with the rates where they are right now. So that's where we are, 225 on policy for the rest of 2026, and that means variable rates are locked in right about where you see them today. The other big takeaway I would say on this is that question that I always get is, it's a really simple one. It's Rob, where are interest rates going? And it's a really simple answer right now, because that answer is, well, interest rates are going where you see them today. And by that, I mean that today's interest rates represent a very neutral environment, whether it's the Bank of Canada at 2.25, whether it's the GIC or savings rates you see when you pull up your investor screen, whether it's 10-year yields around 3.5%, whether it's The mortgage rates you see when you walk into the bank, let's call it 375 to 4.25, depending on the type of borrower you are and the type of term that you're taking. So the two big takeaways on rates would be we don't see much movement at all from the Bank of Canada for the foreseeable future, call it all of 2026. That's number one. And then number two is if you're looking at real estate and just interest rates more broadly from a longer term planning perspective, the numbers that you see out there in the market today are probably numbers that you can safely plan for going forward over a much longer period of time. And of course, there's always an economic cycle. We're going to move around neutral levels, but this is a level that you should be budgeting for. The flip side of that is that if you're sitting there waiting for interest rates to just go back down to 1.5% so I can get back into the market, you're going to probably be disappointed on that front. Okay, so that's where we are on rates. And of course, if there are questions on that later on, happy to jump back to any more of the details on rates. So that's kind of the macro backdrop where we see things like growth, inflation, and interest rates. So with that environment, we can look a little bit at the housing market in some more detail here. So the first thing is the big question we have for 2026, just from a broader macro and even a financial stability and market stability perspective, is this wave of mortgage renewals. We've been pretty, I don't want to say like dovish on this mortgage renewal issue, but we haven't been as concerned as maybe the popular narrative for a couple reasons. Number one is that if you look at, yes, there are probably about 1.5 million mortgages coming for renewal this year. Good chunk of those are 5-year fixed, so they would be coming off rates that were sub 2% 5 years ago. Another chunk of those is variable, which would be again coming off 5-year variable terms 5 years ago that were locked in at pretty low levels, and in some cases payments weren't keeping pace with interest rate increases. But a good chunk of that is short-term fixed as well. So something like a 3-year fixed 3 years ago would actually be seeing rate relief coming into this environment, sub 4%. So we balance it all out, and the shock it's there, but it's manageable. It's not going to create something like massive, like widespread delinquency or forced selling, but households are going to have to make higher mortgage payments, and that's probably going to keep a lid on discretionary consumer spending. Second thing is that banks have been working with households. So in general, like households and financial institutions are in fact pretty smart, and they can see these renewals coming at them 2, 3, 4, 5 years down the road. And in response to that, we've seen savings built up on the sideline. Household liquidity is actually exceptionally strong right now, just given what's happening with wages and in financial markets more broadly. So there is a cushion there. And then, of course, banks have been saying, look, you have this renewal shock coming. You might want to get ahead of that by increasing payments and things like that. And even in a worst case scenario, banks are prone to kind of reassess with the borrower and amortize out at renewal so that the shock is manageable. So that's number two. And then the third thing is that we do have a stress test in place in Canada, of course, and it is a stress test that has proven very valuable at this stage of the cycle. So when you look at where mortgage rates are renewing into now, let's say 375 to 4, the reality is that most borrowers, if you were at a federally regulated institution 5 years ago, you would have even back then been stress tested at around either 475 or 5.25, depending on the exact timing. But the point here is that rates that we're renewing into now are a good half to a full percentage point below levels that borrowers were stress tested at 5 years ago. So that's a pretty good cushion that we have in place as well. And I remember doing presentations and meetings to the real estate industry 5 years ago, and one of the biggest questions was, why do we have this stupid stress test at 5.25 when rates are 175? It makes no sense. Well, it's a good thing we do, because that's actually going to be proving to put a pretty good cushion under the economy now as we roll these 1.5 million mortgages through renewal. Okay, so we do think that the economy and the market in the broad sense can handle it. Okay, so that in mind, where we see this real estate market going. So we made this call back right at the start of 2022 that we were going to see a correction, and it was going to be a significant correction. It was going to be one that is measured in years, not going to be measured in months or quarters. And we are moving into, I believe, year 4 now, where prices are down and probably entering the period where they kind of just stagnate and go sideways for a couple of years still. And I'll give you some context on why we think that's the case. But first of all, like, you can look at how this cycle, and I pick Ontario here because it's probably the most extreme downturn that we've seen in Canada, and map it onto some past real estate cycles. And look, it's really not uncommon for housing cycles to play out over a number of years. So we saw it in the US, we saw it in Ontario in the 90s, even some major structural swings in areas like Calgary. It's not uncommon to see a market take 3, 4, 5 years to bottom out and take 6, 7, 8 years to get back to peak levels. And that's the process we're going through right now. And the reason we made this call was that back at the height of the market in 2022, if you looked at what was going on, literally every factor that could drive house prices higher was converging on the market at one time. And so you turn around there and you project that forward. We say, well, how can the market get any stronger than this? It really can't. Like, at that point in 2022, you had peak millennial demand domestically in Canada. The unfortunate issue with the immigration numbers is that we saw a significant burst in immigration right at the same time when domestic Canadians were forming households at probably the strongest clip, creating a lot of competition in housing. Now we push that forward, the millennials getting older, the first time incremental home buyers kind of moved through the system. That demand curve is starting to fall off. Population growth in what I like to look at is the 25 to 39 age group is starting to fall off. Immigration falling off. We talked about that. A lot of the liquidity and the ultra low, deeply negative interest rates that were in place right at the height of 2022, well, that was an anomaly. That wasn't the norm. So we've pushed past that. And all this kind of happened right at a time when speculation was high and valuations were really stretched. So it didn't really leave anywhere to go except down. And that's where we are. And now we're in the environment where, okay, we've seen a 20% correction roughly in national house prices. When do we start this recovery? We'll start this recovery when the affordability and the investment calculus start to make more sense again. And we're just not quite there yet. And I'll show you what I mean. The other big thing to keep in mind here, though, first is when we look at the regional breakdown here. So we're always asked to make Canadian housing market forecasts, but the reality is Canada is a collection of very local housing markets, and it's not the same everywhere we go. So 2026 is a year where we're going to start to see some more continued fracturing in housing market performance. So Western Canada, especially BC on the soft side, as you get into the prairies, markets are relatively tight. I think Calgary was kind of an investment hotbed that's cooling off, but that's a very specific story. Quebec, Montreal, Atlantic Canada, there really has been no sign of a housing correction at this point, to be honest. Prices there are near record highs. And if you look at the market balance here on the screen, those markets are still relatively tight and pointing to firm prices. It's really a Southern Ontario and Southwestern British Columbia story with respect to this housing correction. And that's where markets are still relatively soft from a sales relative to listings perspective, and suggesting that those are the markets that are going to still be tough in 2026. You probably even have to break it down a bit further. And if you look at a market like, let's say, the GTA, you're going to start to see a big difference between the small investor dominated 1-bedroom condo space, which I personally believe is still years away from firming up, and the single detached market or the freehold market with 3 bedrooms on a decent sized lot with a backyard where there's really significant demographic family demand. We're not there quite yet, but I suspect you're going to see that market firm up quite a bit sooner than that investor dominated condo market. So look for this kind of regional separation to continue, and also look at some point over the next year or two for some separation in asset classes within real estate within specific cities themselves, like the GTA. Two things here to kind of help figure out where we start to see a firmer bottom. So we can look at it from the perspective of affordability. Just think of a household going out there to buy a house to put their kids in, and from the perspective of an investor. So in both cases, we need just more time for the market to adjust, and we're not quite there yet. So this is a chart of housing affordability, unaffordability, we call it, because as you go up this chart, housing gets more expensive. You can also just think of it as a really basic valuation model for Canadian house prices. High on the chart would be overvalued relative to incomes and interest rates. So what it does, it basically looks at, what does it cost to carry the average priced house at current mortgage rates with 20% down relative to household income. And of course, the reason we got really bearish at the start of 2022 is look where valuations got. We didn't see valuations that stretched until, since really the late 1980s in Canada and Ontario. So we're in the process of, like any market, when valuations get out of whack with fundamentals, in the process of bringing valuations back down to levels that make more sense. So there are three things that can change here to normalize valuations. You can have house prices fall. That's the fastest way, which they have. We've cut probably 15 to 20% off national house prices. You could probably see another 10, 15% reduction in house prices, and affordability would look quite normal tomorrow morning. But we don't necessarily want to see that. If we had a legitimate recession, we would see that, but that's not necessarily the outcome we want to see, okay? So if prices start to stabilize here, something else has to happen. You could have interest rates come down, which again can very quickly normalize affordability. We've seen the Bank of Canada cut interest rates significantly, which is, combined with house prices, one of the big reasons why affordability has improved pretty dramatically over the last 2 years, to be honest. And you can see that in the chart. But as we talked about, we're probably not going to see the Bank of Canada cut rates any further this year. And that kind of eliminates further interest rate relief from the calculus here. And so when you do the arithmetic on this, actually, one thing that's kind of interesting is if you take current price and income levels and you start plugging in 3% mortgage rates instead of 3.75 or 4, or anything like right around 3% or slightly below, affordability very quickly kind of finds its way back to normal. And I kind of get the sense that that's a level of mortgage rates that would really start to bring housing activity back up off the floor. We're just probably not going to get there on mortgage rates. Okay, so third thing then would be, well, you can have incomes rise, obviously. And incomes are rising. The problem is income growth takes time. So if we're growing 3, 4, 5, 6%, depending on the cohort for income growth right now, that will eventually restore affordability. The problem is that just takes time. And so this is why we kind of build out this thesis that this is a multi-year adjustment period. And the initial dramatic phase of this period has now kind of passed, where we had the interest rate shock, house prices corrected, interest rates have normalized. Now we're kind of entering the phase where everything just kind of goes sideways. Interest rates hold around here, house prices go sideways and don't do much of anything, and incomes gradually grow. And we're going to wake up one day. It's not going to be tomorrow, but it might be late this year, sometime in 27, sometime in 2028. And the market's going to realize, oh, housing is suddenly affordable again. And this is a very, typical progression for a market going from extremely stretched back to affordability. So that adjustment goes on. It just takes a little bit more time. Look at it from the perspective of an investor too, and you get kind of a similar takeaway where we just need more valuation adjustment and more time. Okay, so this is a picture of investment cap rates, and we're using Toronto as an example here versus risk-free government bond yields. So at the height of the boom in 2022, what you saw there was a really, really tight risk premium between real estate and risk-free assets. So there was a period there where investors just kind of disregarded cash flow fundamentals. They didn't matter because prices were rising 20, 30% per year, and cash flow didn't matter when I can just flip a contract on assignment or flip a property at closing, or just change the floor and paint the cabinets and sell a property for 20% more. Cash flow didn't matter. Well, what's happening now is house prices, of course, are down, and they're at best going sideways. So that capital appreciation has been scrubbed out of the equation. So what does an investor have to do? They have to go back to pricing real estate based on cash flow fundamentals. And right now, that just doesn't really work still. So cap rates need to widen out further, or interest rates need to come down to make it more compelling. And remember, real estate is in fact a risky asset, even though everybody forgot that. It's an asset with really low liquidity, uh, tenant risk, prepayment risk, and a lot of capital and maintenance risk that goes into it. So compared to something like a risk-free government bond yield or highly liquid dividend stocks, there needs to be a premium there, and we got away from that. So going forward, we are in the process of still normalizing this. One way you can get cap rates up is to have rents grow. And this is where I start to get a lot more bearish, is because when we look at the rental market is probably still in the really early stages of correcting to the downside. So investors are very shy in this environment, as they should be. So can round it out with just looking at what's happening on the supply side, and we can kind of square the investment circle here. So ordinarily, at this stage of the cycle, when sales have been down on the floor and prices have fallen, you would usually expect to see housing starts in Canada correct. Usually housing starts will follow demand down with 6, 8, 12-month lag. But interestingly enough, the housing start numbers in Canada have actually held up relatively well. Below the surface, though, you can get a picture of what's going on here. So on the condo side, new construction activity has fallen off. On the home ownership side, we've fallen off. In both cases, we haven't seen levels this low since probably when we were coming out of the financial crisis in 2009, 2010. In fact, you look around the GTA, where I'm sitting right now, and investment activity is dried up to basically zero. Pre-construction activity is basically zero. It's technically not zero, but it's as close to just no activity as you're ever going to see. So the new construction side of the condo or ownership market is falling off. And as we go through 26, 27, 28, the legacy of conditions now is going to be that side of the construction market actually gets weaker, doesn't strengthen. The flip side of that, and what's been masking this, is purpose-built rental supply has been running at a really strong pace, and the pipeline is very full. And some of that reflects market conditions that existed in the past, right? We had 3% population growth. The rental market was drum tight. Well, the problem is that you had, on top of that, you had CMHC incentives like MLI Select, where you could literally go out there and get a 95% LTV loan and a 50-year amortization if you were bringing a purpose-built rental project to market, right? So all this incentive was in place. The problem is supply takes years, especially if it's something like a big purpose-built rental project. That supply takes years. The demand curve can change in minutes, whether it's change in interest rates or the stroke of a pen on the immigration program. And so what we've seen now, of course, is that supply pipeline is very, very chock full of new rental supply coming to market this year, next year, the year after, at the same time as the demand curve has completely fallen off. So I think rents are under pressure for quite some time still. And because of that, I do think that the investor is going to remain very, very shy in this environment until we can get some clarity on where the market balance is going to settle in. And of course, what does this mean? It means that as we go through the rest of this year, 27, 2028, overall Canadian housing starts probably actually back down and fall off. They certainly don't double or triple like policymakers have been pushing for. And frankly, that's a goal that was never really possible or feasible one at any rate. So the market is correcting itself, and the market is doing what it usually does. In real estate, the nature of how quickly supply and demand can change just means that these cycles take time to play out. And by time, we usually mean years. We don't mean months or quarters. Okay, so that's the process we're working through. Okay, I will stop there. That's just a summary slide. If you want to take away with you, it's where we are today based on what we've talked about and what we think we'll be looking at 6 to 12 months down the road. So growth a little bit firmer, but still kind of at or slightly below potential. Inflation a little bit above the bank's target. Interest rates more or less right around the low end of neutral. And then for house prices, we do think it's still a pretty tough environment, depending on where you are and depending on the segment. It's probably going to be a little bit less bad, but we just don't think there's a whole lot of room for prices to move in 2026. On the rental side of the market, we've seen early signs of weakness. I do think it's still early in the game and rents are going lower, not higher. And we do think construction activity is going to remain, let's call it relatively robust, but slowing down from levels we've seen over the last year or two. And again, certainly not doubling or tripling like policymakers are pushing for. So I will leave it at that, and happy to take any questions.
Fantastic. Thank you, Rob, for your excellent presentation. So many moving parts to consider, so many unknowns still in the market. So it's going to make for an interesting next several years in the housing market. Let me ask you a question about investor activity then. And last summer, the IMF put out a report saying the banks are exposed to commercial and residential real estate. And this could become an issue only if we're in a state of a prolonged economic slump. January jobs numbers came out, for example, not too long ago, 25,000 jobs lost. So we are in a bit of a situation where economic activity isn't picking up as one would expect. Growth is still anemic. How does that influence the supply side of the equation? You did indicate that construction activity is going to pick up, but do you anticipate, unless things change in the broader economy itself, if we get some clarity with, let's say, with the tariffs, and if things stabilize, do you see yourself maybe revising that assessment that in fact construction activity might slow down even further, and then that puts added pressure on the supply side of the equation and then on housing prices?
It's a good question. We actually do think construction activity is falling over the next 1, 2, and probably 3 years. It's not rising. So that's our baseline view, just based on the pipeline of supply that's still coming to completion right now, which is a lot, and the market environment in which that supply is going to be meeting, which is a much softer demand curve, especially on the rental side. So that sets the stage for lower supply down the road, just purely from the market dynamics. Okay, the market builders are pretty smart, right? They're going to bring supply to market if the market needs it. They're going to hold back supply if there's no pre-sale activity or the market doesn't need it. To your question too on the financing side, so the fact that like we're not seeing financing like retrench in any sense. We're still seeing pretty decent overall credit growth out there across the the lending market. But the reality is, you look at what a new builder is facing right now, and again, pre-construction demand is effectively zero in a few cities across Canada. So without pre-construction sales, which are historically very investor oriented, that builder can't go to the bank and get financing until that project is 70 or 80% pre-sold, right? And if that financing isn't there, obviously that project's not breaking ground. So this is all, you're exactly right. This is all setting up an environment where with a lag of 1 or 2 or 3 years, it's going to result in lower housing construction activity going forward, not higher.
So on that note, then, CMHC is suggesting that even by doubling the pace of construction over the next decade, housing affordability will reach 2019 levels, which wasn't all that affordable to begin with, but at least it would be a better situation. So they're suggesting that there's going to be a need for at least 430 to 480,000 starts per year. In your estimation, then, and given everything that's going on with a bit of a volatile economy, is this even possible? Are lenders looking to reduce their exposure, and then the home building, the construction companies, are they? And I think you alluded to this a little bit, that they've kind of stopped a little bit. They're not breaking ground. So what needs to happen? That first of all, is that 430,000 housing starts even remotely possible / realistic? And what needs to happen? Do we need to see a jump start in the economy? Do we need to hit, like, say, 2% growth rate before the credit market begins to loosen a little bit, and then to that this becomes a possibility?
Yeah, the short answer is there's zero chance we're going to see 450,000 housing starts per year. That is what it is. We said this from day one. I think it was budget 2022 that had a very ambitious, supply push in it. It said we were going to triple housing construction over the next decade. From day one, we said that this is not going to happen. The industry was already operating at full capacity. So you can't explain to me, unless there's some kind of productivity miracle, how can an industry that's operating at full capacity triple output without having massive inflationary consequences? You can't. The builders were already putting up every last unit they could, and that took us to, just shy of 300,000 units per year. And now market dynamics on the ground we talked about this, are such that construction is actually going to go the other way. And look, to be honest, I don't think, I think we are naturally finding our way back to affordability. It just, as I've kind of reiterated, it takes years to get there because it's a really slow moving market and slow moving asset class. Interest rates are down. We've scrubbed a lot of the froth out of the market, and incomes continue to grow. And that will eventually get us back to something that looks more affordable. I think, 2018, 2019, pre-pandemic, you saw the affordability chart that I showed was actually a reasonable level of affordability for most markets in Canada. So like, some of the CMHC work that's been out there in the past that has kind of guided this supply target has been based on affordability levels that were taken really early in the 2000s. And, kind of opens up this question of what's the right affordability benchmark. The late 90s and the early 2000s were generationally high affordability. That was a market that just went through a 10-year bear market. That's levels of affordability you probably don't want to see again, because it's going to come in economic conditions that you don't want to repeat, right? It would be kind of like saying US housing was really affordable in 2011, and it was, but we know why, and we don't want to repeat that. So anyway, that's kind of the process we're going through, and I'm still a firm believer that those supply targets will not be hit. No.
So then you're suggesting that affordability is really going to come from rising incomes and interest rates, mortgage rates still staying fairly steady. So that's not so much because of this push for significantly higher housing starts, as we're hearing. So the political message, right? So when the budget came out, there was this push for, yes, we're going to increase housing starts significantly. But if I'm hearing correctly, your position really is it's income levels that are going to determine housing affordability, not so much the push for extra supply on the market.
Yep. Market conditions incomes, interest rates, market conditions will dictate the amount of supply that comes to market, and the market will eventually work itself out. That's how a proper functioning market operates. In real estate, it just takes time because of the big lags. I will say this, look, I will say from a policy perspective, if there's one thing that I 100% do agree on, it's that any measures that can, improve productivity in the housing space, especially like in the construction space, whether it's some of the modular investment and that type of thing, great. Anything at the provincial or the municipal level that just speeds up the approval process, gets development charges down, all of that is great because it makes the supply curve more responsive. It's not necessarily going to bring more units to the market, but if the supply side can respond faster to changes in demand, it will eliminate some of these it's not going to eliminate the cycle, but it's going to kind of temper the length and the extremity of some of these cycles, if you know what I'm saying. So I think those are very worthy policy goals. It's putting a astronomical number on the supply that's not going to be hit is not really it.
Very good. I have a question from the audience. Has to do with a change in foreign investment. Do you think we will see a change in foreign investment in some of the markets in Canada? As an example, money being moved around from the GTA market to Quebec or Montreal. And I guess this sort of ties in a little bit with, and there is this big question mark, that how come the regional divergence, how come in some regions we're seeing the housing market still remain quite robust? And I think in the graph, the chart that you showed, Quebec City, Atlantic provinces are doing quite well. Is that because of economic performance? Is there internal movement of labor? What is it that's driving this significant difference and divergence between the regions when it comes to the housing market? And is foreign investment, foreign money involved in that?
So I would say it's a couple things. Number one is from a demographic perspective, like just going back to really early post-pandemic, you did see a lot of movement to markets like Alberta and Atlantic Canada.
Mhm.
And those markets were, especially like in Atlantic Canada, were relatively underbuilt for 10 or 15 years. So you had a really significant influx of demand, and those markets really tightened up. So and think about like a young family moving for affordability reasons to one of those markets, right? And competing for a single detached housing out there. And that is still in a lot of cases in place. So the migration pattern, the flows have actually stepped back a little bit, but you do still see really strong migration flows to those provinces at a time when a province like Ontario or a BC is seeing a really significant outflow of non-permanent residents. Those regions are still pulling in population from other areas of Canada, and those are cohorts that are typically big home buyers, right? Because they're usually
Mhm.
younger families. So that's helping. The other factor, and I would say probably like equally as important, we look across the valuation spectrum at the height of the market back in 21, 22, and we say, okay, where is there a lot of froth? Where is affordability the most stretched? Where was investor activity most dominant? It was the GTA, Southern Ontario, and Vancouver and parts of southwestern BC. So the reality is that there was just that much more valuation froth to clean up in those markets versus somewhere like, let's say, a Halifax or Montreal, a Calgary, where you had just come off of 10 years where those markets did a whole lot of nothing and valuations were actually very favorable on a relative basis. So there is almost a price arbitrage, so to speak, between a market like Toronto, Vancouver, and those others.
Any speculative activity that folks are just saying if Southern Ontario, for example, is not as robust anymore, that not necessarily driven by the fundamentals of economic growth and even significant movements of labor. I don't know, by the way, like, are you observing significant, large enough to really affect the housing market? Could there be some level of speculative activity that's going on in other regions right now?
Oh yeah, 100%. So Calgary would be a good example where Toronto's market got really stretched and peaked. Investors left really quickly,
Mm.
and one of the places they went was Calgary. So Calgary from 22 through 2024 was probably the strongest market in Canada. And anecdotally, it was a lot of investment activity and a lot of dollars coming in from outside the province. Not necessarily foreign, but even somebody that would have sold out of Ontario and shifted their
Oh.
investment focus there. That's now look, that's kind of died out a little bit. Calgary's market is actually falling off and turning, and I think that's one of the reasons is that investment bid is kind of backed out. And even like you get into some of the really small Atlantic markets like the Halifaxes and the Monktons, and yes, you kind of see the same thing going on. The cap rates were a lot higher, population dynamics were quite a bit better, supply was a lot scarcer, and it's really easy to move a really small illiquid market like that with a few incremental investment dollars coming out of a market like the GTA, right? So we have seen that, yeah.
So then the follow-up question I'd have to ask is, could there be a reversal?
I think so. Yeah.
Right, yeah, so that
So here's what probably happens, and I think you're already seeing this. Calgary has already come off the high,
mm,
and we've already seen 6-8 months of a correction there. I think that actually continues. Montreal's the Atlantic Canada's probably settle off and level out. And then at some point, you're going to see the markets like the Vancouvers and the GTA actually find a floor and start to eventually come up a little bit. It's a little bit too soon. And there are some distinctions, obviously, between single detached and quality investment properties and let's say the small condo market in the GTA.
yes.
But eventually this relative performance gap will narrow out. Yeah.
I do have another question from the audience. On the supply side, do you think that the housing shortfall, CMHC estimating around 2 million, PBO estimating around 600,000, puts a floor to real estate price decline? And is the floor where we are now, or how much longer, how much lower can the GTA go?
There is a floor based on demographic demand. Yes, I don't necessarily agree with those numbers, just based on the mechanics behind them. But there is a floor. The rental market is tougher. We talked about that because there is a ton of supply coming and the demand curve is falling off. So I don't think you're going to find a really near-term floor there. But something like single attached housing, freehold or single attached, will find a floor because, again, that demographic demand is there. The peak of the millennial right now in Canada is about 35 years old. So we always kind of look at, I mentioned this earlier, that 25 to 39 demographic as being a big driver of incremental housing demand, household formation, right? Think about somebody graduating, getting a job, having kids, moving out of mom's basement. So even within the population domestically, we're creating households and housing demand, and we're right at the peak of that now. So because the market's been so disrupted the last couple of years, I think there is still a kind of shadow demand out there. There's probably also pent up supply, to be honest. A lot of listings that didn't sell, they're going to come out in the spring, and those kind of fight to a draw. But to your question, there is a floor demographically, and there's a floor too just on the cost of replacement, right? If you were to go buy a vacant lot somewhere in commuting distance to Toronto, for example, that's going to cost you $1 million at least for a 40, 50 foot lot. To replace a 1,500, 2,000 square foot house at $400 or $500 a square foot, at some point soon, you're going to be basically below replacement cost in the resale market. And that too, in theory, should put a floor on the prices at some point. So that's what, again, kind of another reason why I think we're close to the lows here. Doesn't necessarily mean the market's going to snap back, but we're probably getting pretty close to the lows.
Very good. Thank you. This has been a fascinating discussion, and I've been given the 5-minute warning, which is now the 3-minute warning. I would like to remind everyone, if you could please, the short survey is now on your screen. If you could be so kind and to complete the survey, it helps us improve our programming. Rob, as a final question, in your view, what is the most underestimated risk now to the 2026 outlook that could really upend current expectations? That could, maybe when we bring you back next year, that you say, you know what, I missed this point, and then we should now revise it. So is there something that is now back your mind, thinking that maybe this could really affect the assessment that we're currently engaged in?
Okay, you said underestimated. So I'm going to ignore things like the political and trade uncertainty because everybody's talking about that. I'll ignore things like AI and its disruption on the job market. Everybody's asking about that. Ignore the reality that this housing correction draws on, especially in the condo space. Underestimated, I would say there's entirely a possibility that interest rates actually look higher a year from now and not lower. And the market right now is pricing in 3 Fed rate cuts. Well, it's pricing in 2 or 3 Fed rate cuts. And I understand there's a political influence there that needs to be accounted for, but that economy is growing at 3% with 2.5% inflation and a ripping equity market. You could very well have the Fed at some point raising rates. And if the yield curve steepens and it kind of lifts Canadian yields higher too, you could be looking at fixed mortgage rates in Canada that are actually higher next year, not lower, with the Bank of Canada on hold at best. So maybe that's a risk, that interest rates not only don't go down or stay steady, they actually nudge higher.
Okay, very good. Well, that's all the time we have for today's webinar. Thank you all for your excellent questions, and thank you, Rob, for sharing your insights with us. It's a very interesting discussion, and housing will likely continue to dominate discussions at every level in the years ahead, given all the challenges the economy faces. Before we close, a quick reminder to please use the QR code on the screen to register for the last 2 webinars in the series. Chris Sands from Johns Hopkins University will join us on Tuesday, February 24th, as he returns to discuss Canada-US relations and how trade talks are likely to unfold. And on Tuesday, March 31st, Royce Mendez from Desjardins rounds out the macro series for this year with a discussion about Canadian government bonds, capital flows, and what they might mean for nation building and the economy overall. This should be an excellent follow-up to our discussion about the Canada-US relations. All webinars begin at 11 a.m. We'll leave the QR code up as long as possible, or you can go to globalriskinstitute.org to register for the event. Thank you again for joining us. Thank you, Rob. And please remember to take a moment to rate the event before you leave. It really does help us continue to improve our programming. Enjoy the rest of your afternoon.